She doesn't care about any of this. Today I'm going to talk to you about compound interest. Compounding is the process through which interest is earned upon both principal and accumulated interest. Over a long timeline, it makes a huge difference to your life, but only if you leave it to work for you rather than against you. During this video, I'm going to explain what compounding interest is, how it works, and some practical ways that you can make it work in your favour. The idea of interest being charged on additional interest may not sound too bad, but it actually makes a surprising amount of difference. Consider for a moment that for much of ancient history, the charging of interest was considered to be usury, a crime of unfairly enriching the lender. Where interest was permitted, the charging of compound interest was often still illegal under the same law, meaning that where loans were made over many years, it was common to disguise compounding as trading activity to prevent persecution. Loans made with interest charged on a compound basis were therefore illegal. As the 16th century came about, restrictions on charging compound interest, many of which were imposed by religious institutions like the Catholic Church, began to fall away. This, alongside the wider circulation of books following the invention of the printing press a century earlier, made mathematical tables and the information required to make compounding interest more commonplace. In the case where a transaction spanned over multiple years, compound interest was often the expected standard. So to show you why compound interest matters, and indeed warrants a whole video, let's demonstrate the difference between how simple and compound interest works. Imagine for a moment that you've got two savings accounts. Both earn interest at 10%, both contain £10,000. No withdrawals are made and no further contributions are made. But the first earns simple interest, meaning that interest is only charged upon the principal, and the other earns compounding interest. The difference doesn't appear massive in the first year, where the simple account earns £1,000 and the compounding account earns £1,050. There's nothing world-changing about the difference in earnings in the first year. Compounding is a more powerful force over longer periods. After 5 years untouched in that savings account, the difference becomes more noticeable. The simple account will have earned £5,000, which is 10% per year over 5 years. However, the compounding account will have earned nearly £6,500. That's an additional £1,500 for what could easily be confused to be the same rate. Finally, if we look at the 10-year mark, the simple account will have earned £10,000, doubling the initial investment. However, the compounding account will have earned just over £17,000. That's rapidly approaching double the return of the first savings account. Just in case you're interested, the compounding account doubles the return of the simple account at year 13. This example is a bit too clean to be reality, but hopefully it proves a point. If you can afford to lock money away for an extended period of time to earn interest uninterrupted, then you'll benefit at a disproportionate level. In my view, this is a large contributor to the gap between rich and poor in the Western world, which has been growing for the period of time I've been alive. Because when your net worth is sufficiently high, say above £5 million, you could reasonably expect to earn an income of £250,000 a year in interest, assuming that your money only earns 5%. If you cannot spend all the money you earn from savings and investments, the money that you do not remove from your account is then used to acquire further investments, which makes you richer long term, even if you don't try to earn more. By comparison, if you pay interest on your debts, you're on the opposite side of the equation. This could be the case if you have debts such as a mortgage, a car loan, or credit cards. It's also very difficult to save and invest when you have commitments like this to pay for. Overwhelmingly, if you're not a rich person with a high net worth, this is the position that you and most of us are in. The House of Commons Library released a report in March 25 showing that if you include all consumer debts, the average British household is in debt of roughly 120% of the household income. It isn't clear what income number has been used from the information on the report, and I suspect what we're talking about is pre-tax income. What hits your bank account is going to be much lower than that, and so it's important to recognise that this number may be much worse. While incomes have risen since 2008, meaning that our debt-to-income ratio is better than during the global financial crisis, this has only happened due to the average British household earning more. Rather than being in less debt, we're actually in more debt now than we were in 2008. The median household debt, meaning that if you were to lay all British households out on a line from those with the least to those with the most, the middle household on that timeline has about £30,000 worth of debt, and the majority of it is student loan debt. And finally, a fifth of all working people in the UK had low financial resilience, meaning that they would struggle to suffer an additional £50 a month bill or a week without pay from their main job. Anyway, to get back to compounding interest and stop getting distracted, compounding interest is the standard in the modern Western world, and so finding a debt or savings account which uses simple interest, is very unlikely. However, the examples that we've been through show what happens where interest is allowed to compound over an extended period of time. The most important lesson to learn from this video is that compounding interest is incredibly powerful. In order to make it work for you, you must treat it appropriately. There are a number of straightforward ways to approach this. Pay your debts on time and in full. This avoids allowing fees and interest charges to compound over time and become impossible to manage. Fees and interest serve a purpose, but that purpose is to make the lender rich and not you. Wherever possible, try and move any debts you have to a 0% or lower interest form of borrowing. If there is a cost to doing so, it may very well be worth paying it to pay less interest overall. Quick hint, when you're refinancing a loan, the early repayment charge is often calculated by reference to the next 60 days of interest. To get around this, pay off most of the balance of the debt, wait a week or two, and then ask for a settlement figure. You'll find that the settlement figure and interest penalty will be calculated based on the lower balance, meaning you pay less in an early repayment charge. Create savings and investments once you're out of debt. Don't just spend your extra money. These savings eventually start to create another stream of income for you in interests and dividends. Use tax-efficient ways of saving and investing, such as ISAs and pensions, to avoid the government taking a slice of the income that you fought so hard to make in tax. That's your money and not theirs. If you have children, begin investing small amounts of money into children's ISAs. When you're an adult with responsibilities, it's hard to make space for savings, but the money you put aside for them can grow for 21 years before they get access to it. It may very well be life-changing for them. Finally, don't opt out of your pension. A pension allows you to put money away tax-free, so the money you're investing is already either 20 or 40% better off than it is as pay right now. That money sits in the market each year and grows gradually until you can draw it as an income. If you follow these tips, you won't get rich, but you will get the most out of compounding interest and make those big decisions in your life easier. On my channel, I make videos about personal finance, covering everything from the basics to more advanced topics. My most recent video will be showing on screen, and I'll see you next time.